Introduction to the Income Tax Act 1961. Taxation is an essential aspect of any modern economy, and India is no exception. The Income Tax Act of 1961 forms the bedrock of India's tax system. It provides the legal framework for the levy, administration, and collection of income tax in the country. The Act has undergone numerous amendments over the years to keep pace with changing economic conditions and government policies. In this video, we will provide an informative introduction to the Income Tax Act 1961. History and context. The Income Tax Act 1961 replaced the earlier Income Tax Act of 1922. The objective was to consolidate and streamline the tax laws in India. The new Act sought to simplify tax administration, expand the tax base, and make the tax system fairer and more equitable. Key provisions. The Income Tax Act 1961 covers a wide range of provisions that govern the taxation of income earned by individuals, companies, and other entities. Here are some key provisions of the Act. 1. Tax slabs and rates. The Act prescribes various income tax slabs and rates applicable to different categories of taxpayers. These slabs and rates are revised periodically by the government through the annual budget. 2. Taxation of individuals. The Act classifies individuals into different categories based on their age and income levels. It provides exemptions, deductions, and rebates for specific types of income, such as salary, house property, capital gains, and business or professional income. 3. Taxation of companies. The Act outlines the tax provisions applicable to domestic and foreign companies. It covers aspects like the computation of taxable income, carry forward and set-off of losses, and taxation of dividends. 4. Tax deductions and exemptions. The Act allows certain deductions and exemptions to encourage savings, investments, and specific activities. These include deductions for contributions to provident funds, life insurance premiums, home loans, medical expenses, and donations to charitable organizations. 5. Taxation of capital gains. The Act provides detailed provisions for the taxation of capital gains arising from the sale of assets such as property, stocks, and mutual funds. It differentiates between short-term and long-term capital gains and offers indexation benefits to adjust for inflation. 6. Taxation of international income. The Act contains provisions for the taxation of income earned by Indian residents abroad and foreign income earned by non-residents in India. It also covers double taxation avoidance agreements, (TA), signed between India and other countries to prevent double taxation. 7. Tax administration. The Act establishes the framework for tax administration, including the establishment and powers of the Central Board of Direct Taxes (CBDT) and the Income Tax Department. It also lays down procedures for filing tax returns, assessments, audits, and dispute resolution. Amendments and reforms. Since its enactment, the Income Tax Act 1961 has undergone several amendments to align with evolving economic and social conditions. These amendments aim to simplify tax compliance, curb tax evasion, promote digital transactions, and encourage voluntary disclosure of income. In recent years, the government has introduced several significant reforms to the income tax regime, such as the introduction of the Goods and Services Tax (GST) and the Direct Tax Code (DTC). These reforms aim to simplify the tax system, reduce complexities, and improve the ease of doing business. Conclusion. The Income Tax Act 1961 forms the cornerstone of India's tax system. It provides the legal framework for the levy, administration, and collection of income tax in the country. Understanding its key provisions is essential for taxpayers to fulfill their tax obligations and make informed financial decisions. As the Act continues to evolve, staying updated with the latest amendments and reforms becomes crucial for both taxpayers and tax professionals.